day and welcome to this Network Corporation Q2 2020 earnings conference call. Today's conference is being recorded. At this time, I'd like to turn the conference over to Mr. Jason Kaiser. Please go ahead.
Thanks, Jennifer. Thanks for joining us, everybody. I'm joined today by Charlie Ergen, our chairman, Tom Cullen, EVP of Corporate Development, Eric Carlson, our CEO, Michael Schwimmer, our new president of Sling, Paul Orban, our CFO, and on the wireless side, we've got Stephen Bai, our Chief Commercial Officer, and for the first time, Dave Mayo, our EVP of Network Development. And finally, we've got Tim Messner, our General Counsel. Eric and Paul have some prepared remarks, but before we do that, Tim needs to do the safe harbor disclosure, so I'll turn it over to Tim.
Yes, I do. Thank you, Jason. Good morning, everyone. Statements we make during this call that are not statements of historical fact constitute forward-looking statements that are subject to risks, uncertainties, and other factors that could cause actual results to differ materially from historical results and/or from our forecasts. We assume no responsibility for updating forward-looking statements. For more information, please refer to the risks, uncertainties, and other factors discussed in our SEC filings. As part of the process for FCC Auction 105, we filed an application to potentially participate as a bidder for those spectrum assets. Because of the FCC's anti-collusion rules, we're not able to discuss what, if any, spectrum resources we may intend to bid on, and we will not be answering any questions on that auction during today's call. With that, I'd like to turn it over to our CEO, Eric Carlson.
Thank you, Tim, and welcome everyone to the call, to our analyst, media, and investor communities. I hope you're staying well during these tumultuous times, and I want to thank you for being with us today. Before I share a few observations on the quarter, I'd like to take a moment to recognize the entire DISH team and thank each and every individual here for their dedication. I'm certainly proud of the job our team has done in responding to the COVID-19 crisis. Now, I'd like to highlight a few items across our business units. In wireless, we continue to make progress building the nation's first O-RAN compliant 5G network, and since the last call, we've named several key vendors, including Altiostar, Open RAN, Mavenir, Fujitsu, and VMware. Charlie and Tom are with us today and are available to talk progress on our wireless efforts. Now, with regard to the quarter, DISH TV performed well, with gross activations of 268,000. From quarter to quarter, we actually increased by 5,000 subscribers. The crisis has impacted customers' willingness to open direct mail, marketing, and allow for in-home technicians into their homes. And as a result, we controlled costs and reduced marketing expenditures, and our gross new TV subscribers did decrease. Our DISH TV strategy has been anchored to acquiring and retaining long-term profitable customers. For the past 4 or 5 years, we've focused on a more rural and higher credit subscriber base, and we remain committed to that path. We saw a DISH TV net subscriber loss of only 40,000. Our lower losses are primarily the result of a lower churn rate due to COVID-19, partially offset by lower gross new additions with the DISH TV subscriber base. And Paul's going to have more detail on this in a moment. Turning to Sling, in the quarter we lost approximately 56,000 subscribers, and this is disappointing. The decrease in net Sling TV subscriber additions was primarily related to lower Sling TV subscriber activations, a bit of increased competition, and delays and cancellations of sporting events as a result of COVID-19. For both DISH and Sling, while the pace of activations has slowed, we did adjust our marketing and brought more value to customers at an important time by delivering more content and free previews with the help of our programming partners. And as always, we're focused on providing an excellent and safe customer experience. Throughout the pandemic, we've seen customers' usage of our products increase. We're pleased to see the additional engagements of the excellent Hopper experience that platform delivers, including on-demand apps and DISH Anywhere capabilities. And that said, while news coverage was up, the loss of sports changed the viewing equation significantly. And the increased competitive environment was also aggressive, especially from the free and commercial-free streaming services that flooded the space with introductory offers and promotions. With that said, we're going to continue to focus on acquiring and retaining profitable customers and delivering a great customer experience at both DISH TV and Sling TV, as we know we have room to grow. Now, as it relates to wireless retail, we'll discuss results in greater detail on our third quarter call, but I want to touch base on a few key updates. First, this week we announced a partnership with Tucows. We acquired T-Mobile assets, including customer relationships and the brand, and we'll also engage with Tucows on technology services. Next, I want to thank our integration team for their effort over the last several months. Our Boost team has hit the ground running in serving our new customers and welcoming the Boost employees to the DISH family. Our approach to Boost reminds me of when we pivoted DISH TV focus 4 or 5 years ago. And as I mentioned earlier, we implemented a more disciplined strategy in acquiring and retaining profitable customers, and that's exactly what we've begun to do with Boost. Our profitability is determined in part by what we pay to access the network. As most of you know, right now we're operating as an MVNO, much like a track phone. As we roll out our own network, we'll begin to benefit from owner economics, and that will drive profitability and allow us to be disruptive. In the meantime, we know we need to pivot the business. While we haven't yet had a full billing cycle, we're already beginning to focus on acquiring more profitable customers and providing a great customer experience. In closing, I want to express my gratitude again to the entire DISH team. A lot of extra work has gone into taking care of our customers, taking care of each other, and taking care of the communities that we serve. The efforts of the team have been commendable. With that, I'm going to turn it over to Paul for a little commentary on the numbers.
Hey, thank you, Eric. Before we get into the quarterly results, I have two items I want to highlight. First, the impact of COVID-19 on our operations, and second, the closing of the Boost acquisition. As I mentioned in the first quarter, we have implemented a series of initiatives in our pay TV business to address the impact of COVID-19. We tightened our belt and put in place cost-cutting measures to slow the pace of OpEx and CapEx. The benefits of this hard work are reflected in our quarterly results. As Eric alluded to, gross new activations were negatively impacted and churn was positively impacted by COVID-19. As discussed in Q1, since many commercial establishments are closed or running at reduced capacity, we put these accounts on pause or provided temporary rate relief. These accounts represent approximately 250,000 subscribers and were removed from our Q1 ending DISH TV subscriber count. During the second quarter, 45,000 of those subscribers restored service or had temporary rate relief end. These subscribers came back with minimal or no cost, and they were added to our ending subscriber count without being counted as a gross activation. Of the remaining commercial accounts that were removed, 17,000 of these accounts disconnected. We continue to expect the vast majority of the remaining commercial accounts to restore their service in the coming quarters. Combining the 45,000 subscribers discussed above with the 40,000 net subscriber loss related to the other accounts, DISH TV subscriber count increased by 5,000 during the quarter. The next item I'd like to discuss is Boost. As Eric noted, we closed the acquisition, and we will report Boost results for the first time in the third quarter. We believe we will report Boost in our wireless segment, and we will disclose key metrics such as ARPU and subscriber data. We will also allocate the consideration paid to the tangible and intangible assets acquired and the liabilities assumed. All right, now looking at our P&L, our operating income and EBITDA for the quarter are both up significantly compared to last year. Our revenue decreased due to a lower subscriber base, partially offset by higher pay TV ARPU. The increase in pay TV ARPU was driven by price increases at both DISH and Sling, and increases in premium and pay-per-view revenue. In addition, we had fewer commercial accounts during the quarter. Most commercial relationships are included in ARPU on an equivalent billing unit basis, which means that ARPU for these accounts is lower than residential subs. Our subscriber margins for the quarter were positively impacted by reduced costs related to channel removals, including regional sports, and by our paid TV cost-cutting measures. Our DISH TV SAC is down this quarter due to decreased subscriber activations. However, the cost per activation increased from $786 last year to $834. This is largely driven by fewer commercial activations this year compared to the prior year. These accounts have lower SAC than residential subscribers. Satellite and transmission expenses decreased by $67 million. As discussed on prior calls, this reduction in expense was related to the acquisition of certain satellites from EchoStar last year. G&A expenses were up this quarter as a result of costs to support our wireless initiatives, partially offset by cost-cutting measures that we did in the pay TV. Our free cash flow of $574 million for Q2 benefited from improved operating performance and working capital. We expect some of the working capital benefits to reverse in the second half of this year. After redeeming our $1.1 billion debt maturity on May 1st, we ended the quarter with approximately $2.6 billion of cash and marketable securities. On July 1st, we acquired Boost for $1.4 billion, and also raised $1 billion of debt. We still expect our 2020 wireless build-out expenditures to be between $250 and $500 million. However, we will probably end up closer to the lower end of that range. Eric mentioned that we have recently entered into agreements with several wireless vendors. We expect the majority of the expenditures under those agreements to impact us in future years. And then lastly, if we manage success, our goal is that Boost will be accretive to both free cash flow and EBITDA. However, given the promotional and operational changes we are currently implementing, it's too early to predict. We currently have MVNO economics, and therefore, we are pivoting the business to implement a more disciplined approach to acquire and retain profitable subscribers. As we build our 5G network and benefit from owner economics, this will drive greater profitability. With that, I'll turn it over for questions. Operator?
Yes, we will now take questions from analysts. If you are an analyst, please press *1 at this time. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press *1 to ask a question. We'll go first to David Barden with Bank of America.
Hey guys, thanks so much for taking the questions, and welcome on board to Dave Mayo. I guess the first question would be just kind of coming back to this Boost acquisition. In the past, you guys have said that this business would have a track phone-like margin. Recognizing we're in the promotional season, would you stand by that assertion based on what you know over the past quarter? And then second, if I could, Charlie, I think you teased last quarter that this quarter you might have a little bit more kind of concrete information to share with us on the facilities-based build, and we've seen a lot of vendor announcements and obviously new people being brought on board. So if you could kind of give us an update on the status and where we are there, that'd be super helpful.
Yeah, I didn't quite catch all the second half, but on Boost, I would say that first of all, we don't even have a full month of billing information since we paid T-Mobile for the network. So we are flying a little bit blind here, and John Seringa, who's running that business, we gave him a day off, which we normally don't do, but given his success and the hard work that it was to put that all together and get that closed on July 1st, it was deserving. So we'll have a lot of information on that next quarter because we'll actually have financials. I would say it this way: the margins will be low in the MVNO business until you get owner economics with your own network, and then the margins are quite good. So we have to pivot that business. The big thing that the street needs to understand is we have to pivot that business. Sprint ran that without a P&L, so Sprint ran that business really on a contribution margin basis because they own the network, and the network had excess capacity, so there was no network charge. Internally for them, we have to pay T-Mobile for the network, so we have to run it a little bit different. So obviously, some customers that were very good customers for Sprint potentially aren't good customers for us. And so there's going to be some cleanup there in terms of, and then we're a little bit more conservative on how we account for things, so we'll have a little bit of cleanup there that we'll go through, and we'll try to get all that done in the first quarter rather than wait. So we'll have to wait and see. But
you mean in the current quarter?
In this quarter, yes. But I think as Paul said, our goal would be that we're at least $1 positive in EBITDA and cash flow, right? And then obviously if we do better than that, that's great. And as we build our own network out, obviously we expect that to be materially higher. An update on Dish and where Dish is. We're making very steady progress on our build out of our network. You saw a few vendor announcements where probably the most important thing is we're committed to the O-RAN architecture. We're the only company in the United States that we know of that's doing that. For a clean sheet of paper, we're able to do that. Fujitsu is our first radio partner in that. They obviously are a very respected radio manufacturer in Japan.
we're excited to have them on board to build radios. We are working with other radio vendors too. There's a lot of excitement about O-RAN radios and the path that will go down there. And obviously Mavenir and Altiostar both are doing some of the software for some of the baseband distribution unit. So and then we added VMware, which really allows us to stitch together the cloud. So everything that we're doing is things like Kubernetes, which is a buzzword for containers and microservices, but when you put all that together, you got to make it work, and you got to make it work on different cloud providers and private clouds, and VMware allows us to horizontally go across the stack and stitch that stuff together. So, and the way we look at partnerships, VMware has done a lot of work for us already, even before we signed the contract with them. They're learning a lot about telco and O-RAN, and so they're getting a real R&D sandbox to play in, and they're making our business better, and we're making their business better. So it's a really good win-win for both companies, and they've been a tremendous vendor even before we signed a contract with them. So, the big picture thing is there's nothing that stops us from building really the best network in the United States. There's no law of physics. There's no law of physics. There's no technology that really has to change. It's really execution. It's really execution risk for us and our vendors to make it happen. But we're not reinventing science. We're not reinventing anything. We're just taking really good cloud providers and software providers and making what has been a very clunky, hardware-centric, highly operational cost environment, very similar to data centers 20 or 30 years ago, and we're turning that, we're going to make that into a modern network. So everything exists to do that, and we're just going to go do it. We don't spend a lot of time talking about it externally because everybody's going to be skeptical up until we light it up, and then people will have their opinion about it. So that's what we're going to do. I also would be remiss. I wanted to congratulate Eric Carlson. This is his 25th anniversary at DISH today, and he started out in a pretty entry-level position up in Chicago 25 years ago, and has taken up more and more responsibility. He's been running and doing an incredible job for us for the last 3 or 4 years as the CEO of DISH. And so congratulations, Eric, and a job well done. And it's been fun to watch you grow over the last 25 years.
Thank you, Charlie.
Operator, next question.
Yep, we'll go next to Jonathan Chaplin with New Street.
Great. Charlie, just following up on your on the last question, when do you think we'll have a more complete set of who all the vendors are and how the whole plan comes together? Is that something that's sort of weeks or months away, or do you think this will evolve still over several quarters? And then I know we're forbidden from speaking about CBRS, but I saw the disclosure in the 10K in the 10Q about you being interested in more spectrum generally. I'd love to get your thoughts on the C-band auction that hopefully we're not in quiet period for yet, but also on some of the other pieces of spectrum floating out there like the L-band.
Yeah, in terms of for your visibility, internally it's all pretty much come together for us, I guess is the way I'd say. We have our senior team in place. We know exactly what we need to do. I'll let Dave Mayo, who's in charge of deployment, maybe speak to that in just a second. But we know exactly when you're really a focused company, you're not worried about the external stuff. And a lot of times people try to spend a lot of time trying to convince people what they're doing, and we're not trying to do that. We're just going to go do it, and then you'll see it. So we're in discussions with other vendors. Obviously, there are more that we need to help us to get to where we need to go.
and they have to share the vision. We're uncompromising that they have to share the vision and take some risk with us to get there. And there are many companies. We've narrowed. We had about over 100 companies that have responded to RFPs. We're down to usually 2 or 3 potential vendors for each category that we have left. It is a focus where we'd like to pick best-in-class vendors where they share the vision with us. And if they don't share the vision with us, then, we move on. But I can tell you the people we're talking to today all do. I think the people on the inside of technology and the inside of where networks can go who don't have a legacy. So when you have legacy and you can't do something, obviously you might have a different opinion. You rationalize that maybe something doesn't make sense. But for people who don't have legacy, I think it will become clear to people that the direction we're going is dramatic and it's a paradigm shift and way telco networks to build. And with that, and then in terms of, I can't talk about the CBRS auction. I think that's in a quiet period. We historically have looked at every auction in case there's an opportunity there. We've looked at every piece of spectrum in case there's an opportunity there. Obviously, we would be challenged from a balance sheet perspective. We're obviously cognizant of that. We piece together the kind of spectrum portfolio that you need to compete in a modern network, and we'll continue to look for opportunity there now and in the future. That day, maybe just a little bit on deployment.
Yeah, sure. Thanks, Charlie. And Jonathan, thanks for the question. So our approach really is to vector ourselves towards the 70% milestone that must be completed by June of 23. And in order to do that, we're building a field-based organization to help us with the rollout. And that's kind of really top of mind right now. We're also about midway through completing RF designs for all the markets, having conversations with the tower companies, both at a national level, the big 3, and as well as the second-tier tower vendors in order to build a portfolio of choices. And we think we're in a great shape there. And it's pretty exciting what we're seeing in terms of co-location rates. They're very, very high, and there's lots of choices. In terms of field service vendors to help us get some of the more mundane, detailed work done in the field, there's lots of choices, and the team has done a really good job of building a portfolio of selection on a market-by-market basis that we'll use to help us deploy the network.
Got it. Thank you.
And by the way, this is Charlie. I might just add, just so you have a good sense of timing, that we don't get radios and scale till the second half of next year because obviously we're building a different kind of radio with ORAN. So some of the incumbent vendors weren't able to or couldn't or wouldn't participate in that kind of development. And Dave and team will be ready to go when the radios come in to start climbing the tower. So that's the getting the supply chain and radios is the longest pole in the tent for us right now.
We'll go next to Walter Piecyk with LightShed.
Thanks, Charlie. Just to follow up on saying, your comments around C-band, saying you would be challenged from a balance sheet perspective. Is that something that will factor into discussions that you have with strategic partners to the extent that some type of partner, strategic or financial or otherwise, could provide capital to grab some of that spectrum? Or do you find that C-band spectrum to be not necessary in terms of giving you enough assets to compete over a 5 or 10-year period?
Well, it'd be pretty premature to look at C-band. I mean, and there is an auction going on today. We'd like to see the results of that. There's I think an NPR. I think the FCC's NPRM came out yesterday. I haven't seen it yet on C-band, so would like to see that. But it's certainly a good band. It certainly is one that we have spent time with overseas and played with. And we're certainly in a unique position with a clean sheet of paper. in terms of designing the right network for the future. So, we'll have to wait. We'll have to wait and see where the strategic work. But we feel like we have the information that we need, other than reading the FCC and seeing what happens in the current, basically, C-band auction today, and kind of see where that goes.
Okay, and then
I'm sorry. I'm sorry. That's a non-answer, but even if I knew what I was going to go and tell you.
Okay, I was going to ask you another one on O-RAN, but I don't want to dominate the call like some analysts do, so I'll let Rich hop on with a quick one. But maybe I'll follow up afterwards. Go for it, Rich.
Just quickly, Charlie. We've seen basically every single media company, legacy media company, basically jump head into streaming, from Peacock to HBO Max. Viacom put all of their network brands up on All Access, and they're calling it sort of a superstore or super service that's going to relaunch early next year. With so much of the content on streaming now, and everyone putting all of their exciting stuff, and ESPN sort of teasing putting sports on ESPN Plus, is there any point where you ever expect to actually have rate reductions? Like, will we start seeing you pay less? I know you just did a deal with Viacom that I think surprised a lot of people, but are rates ever going down, or you're just going to pay more even as content moves away from the bundle that you're paying for?
Well, it's a good question. I think that the rates should come down, and I think that when we look at a couple things, but we obviously look at how much people watch something, and we watch at the cost per hour as a simple example, and we see those trends declining for a lot of people in the industry. And the second thing you look at is the product available somewhere else? And if that product is available somewhere else, obviously, then the value to us, because at that point, as an industry, we're non-exclusive, that value goes down. And I think we approach it financially. We look at it and when we make decisions based on the fact that how much it's going to cost us, how many customers we think will lose as a result of that, versus how much money we'll save. One of the reasons, obviously our cash flow has been a little better than I think we had projected because of the loss of regional sports. The loss of customers has been less than we projected because we knew that many of our customers don't watch, regional sports. So there are other categories where they're approaching regional sports status, where those costs are going up beyond what the value is in terms of customers watching those, and those will all be, we'll have to negotiate through that. It's a shame, we look at it as what the value to the customer. I think the incumbent operators look at it for their budget, and they just need to have a number they need to get to, and we obviously, we saw it, Eric and his team saw it 5 or 6 or 7 years ago, and which is why the company pivoted to a strategy that we're less dependent on some of those things. And I think it ultimately will lead a certain direction, and we're prepared for it. And our linear business is solid, and I think Michael's got a great opportunity to take advantage of some of the streaming that, in a way that maybe we haven't in the past. But we're disciplined there, and we're positioned well. Maybe the trend will change, and I'm surprised it hasn't gotten worse for us. But so far, it's we're doing well there.
We'll go next to Doug Mitchelson with Credit Suisse.
Oh, thanks so much for taking the question. A couple questions. One for Michael Schwimmer. Are you going to be shifting strategy at Sling at all? I'm not sure if that was part of the purview for you coming into that role recently. And Charlie, I'm going to throw 3 at you. I think the fact that you're planning on getting the new radios the second half of next year is super interesting. And the 3 questions are, one, once you get the radios, how long does it take you to climb the towers and install them? How much cushion do you have relative to those FCC timelines? I would think it'd be pretty quickly, but I'm just curious.
And does that suggest, Charlie, that you don't really need to procure any financing that last $9 billion of the $10 billion build out really until the second half of next year when those radios arrive? And lastly, just any update. I think you talked about the launch of your first market around year end, and if the radios are coming second half of next year, are you getting some limited supply to do that first market, or has that been pushed off? Thank you.
Okay, Doug, thanks for the question. I think it was whether or not we are looking to shift our strategy at Sling. Sling has been really good at bringing in customers to watch unique events, sports, and whatnot, and made it very flexible for them to come in and leave without contracts and so forth. And we'll certainly continue to be able to do that. I do think that there's a lot of opportunity out there, particularly given our low price point and some of the economic pressures that everybody is experiencing these days. At basically $30, people can get a lot of programming that they want, and we think we're well positioned as folks' entertainment budget gets compressed, as they take on some of these other SVOD apps. We can still deliver a lot of what people want, maybe not what everybody wants, with live linear sports, news and entertainment, and so forth. So I think we will be more cognizant of the opportunity to bring in folks who are going to stay with us longer.
And this, Charlie, first thing you have to do in a network is you have to do the RF planning and the site acquisition. So we have to do that anyway, and then get the permitting and zoning and permitting done, and that typically takes anywhere from 6 months to 2 years, depending on and that's in progress in place today. And then, assuming we execute on supply chain management and so forth as the radios come in, we will strategically, I think Dave would like to build out. He comment on this, but we have critical mass for a city. We won't build a city piecemeal. We'll have critical mass to build all those towers in that particular city at one time. Radios will be there, permits will be there, leases will be ready for the towers, and then it's a task of climbing the tower, installing the radios and antenna, and hooking up everything to make it work. So we have a simpler radio design. We have a simpler antenna design than traditionally you've seen from people. The total weight will be less. The cabling will be less. The amount of real estate we need at the site will be less. So it's another leapfrog in how you might design and deploy something. So we're hopeful that we can go pretty quickly once we get radios. And Dave, you may want to.
Yeah, I think that's right, Charlie. And I just pile on and say that as I mentioned earlier, we're vectoring towards that 70% objective and really getting the early stage activities, albeit design work and site acquisition work, done across that whole suite of markets, with the expectation that there'll be markets that are much easier from a site ac and a zoning perspective, mostly small second and third tier markets that we can light up much earlier in order to achieve that 20% threshold. That's 1 year, 9 months, and 27 days away. 23 days away.
And Charlie, so Charlie, am I thinking about it right that there's really no financing needs until second half of next year, or perhaps even a little bit after that?
Yeah, I mean, for our build out, I think we ended up with, I think I heard a couple $2 billion we have in the balance sheet today. So
2.6.
I think we don't anticipate that we spend that much money between now and next year, but we'll see.
And sorry, lastly, just that first market, are you still planning on launching a market this year, or is that pushed out?
We haven't given up on doing that. We're waiting on prototype radios, and we hope that we'll still have a market up this year.
All right, thanks so much.
We'll go next to Bill Cusick with J.P. Morgan.
Hey guys, thanks. Charlie, thinking about the RDOF auction, headlines from cable companies going deeper into rural areas, and the federal discussion on universal broadband, how do you think it impacts the addressable market for satellite video over time? And with fiber and wireless, the long-term
TAM of satellite broadband look for that satellite video market as well?
Addressable market. You'll have to answer the second. I didn't hear the second part. The first part, the addressable market for satellite broadband, given the RDOF. Well, I mean, I think since I was on the EchoStar I think they have a little over 1.2 million subscribers in the United States. That their capacity is full. There's excess demand. Viasat, I think, reported today around 600,000 subscribers. So the market is 1.8 million today in the United States for satellite broadband. That will get challenged as people build up more in rural America, but the market could use a lot more capacity than it has today. So because I can't speak for Viasat, but I know EchoStar is full. There's new generation. I think what's going to happen is that as new generation satellites come on, speeds will go up and people will use more. But I think there's a solid group of people in rural America that and small businesses and people for backup, and then things like aeronautical and other uses. And then for us, satellite, we look at it, or Dave looks at it. I'll speak for Dave. We look at it in a lot of rural areas. We believe there's broadband, there's wireless backup. So we think there's we don't see that going away. We see that maintaining it, to being a profitable business. And even though the amount of people getting access to high-speed broadband through cable or perhaps fixed wireless will go up. And obviously, one of the ways it's going to go up is because wireless carriers will have the ability to do fixed wireless or even mobile wireless and to compete against some of the cable companies in the future, because 5G is just going to have a lot more capacity out there. So that's going to be an interesting development to see how that goes. And we haven't seen much of an impact from the millimeter wave stuff yet. I would anticipate that the lower frequencies, people will move to the lower frequencies. Ultimately, they'll maybe pivot strategies and maybe have a different story next year because the economics are better. And that's a great place for us. I mean, as a company, we have very good skill sets in satellite. We have very good skill sets in video. We now are incredibly skilled in O-RAN, cloud-based architecture for the next generation of telcos. So we're unique in that sense. And the focus is how you put those assets together to have good services that consumers and businesses and enterprises will pay for, because we get a return on our investment. And obviously, we have a huge investment in telco today, as we do in satellite and video. But obviously, telco dwarfs that today. So, we see. All I can say is everything that we see today is in terms of the core strategy, is better than it was last year, and it's better last year than it was the year before. The technology shift is dramatic. It's not understood by most people. It reminds me of digital when we were doing digital compression when people thought it was impossible or that it would never make a difference. And we knew it was going to make a difference. We knew that analog video was dead, was just not the right way to go once you could go digital. And ultimately, when the technical problems were solved, then it was just execution. And for us, that was launching a satellite and building a set-top box. But we're in the same situation today. There's nothing in the law of physics or technically that prevents us from building this very modern network. That was different a year ago. But the big technical issues that we were worried about, particularly vendors in O-RAN radios, which some people were calling pie in the sky and saying 5 years out and 7 years out, and so the big guys aren't going to do it. You can't buy Chinese. We've resolved that problem, and others are doing that as we speak. And Dish is an execution risk company right now, and the way you minimize the risk to execution is to build a good team. And we've got a good team. We need to strengthen it. We need bench strength, and we need to strengthen it at the lower levels. But we have incredibly strong team that's focused on the mission at hand.
We'll go next to John Hodulek with UBS.
Thanks. Charlie, maybe just on back to wireless strategy. First, on the prepaid side, it sounds like you're focusing on profitability while you have MVNO economics. I guess, should we assume that you guys will be less focused on customer acquisition, and as a result, we may even see prepaid subs decline until the net built out? And then in terms of your entry into postpaid, again, any thoughts on the timing there? And I guess given what you said about the MVNO, should we expect that you really won't enter the postpaid market until you've got sort of critical mass of sort of facilities-based networks sort of towards the end of next year? Thanks.
Yeah, it's a little jumbled, so if I didn't get it right, Tom, you can jump in. But on Boost, we certainly we have profitable customers that, for the most part, in the customers that we acquired, their subscriber acquisition cost has already been paid. They're already customers, so they're for the most part profitable. There are some of those customers that perhaps the way Sprint accounted for them, or perhaps the way they ran that business, they wouldn't make sense for us. So we certainly have some cleaning up to do there, but we'll get that done. As far as new customers, we just announced different plans. Today's really kind of the first day we really own Boost because it took us that long to get our new plans out in the marketplace. So I think there's 5 new plans today at Boost stores, all under $50. The postpaid is a place that is more profitable, even as an NGO as well. And you saw our 2Cal's announcement maybe Monday. Was it Monday? Monday, and they are helping us. Not only did we acquire a few subscribers, but they're helping us with our ability to enter the postpaid business, because that's not something that Sprint or T-Mobile systems would work for us. So, as a sidelight, I'd say that the prepaid business is kind of backwards. The United States is really the only country that I know of where the prepaid business actually is less expensive than the postpaid business. So today in the prepaid business, you normally can get a free phone or near free phone, even though you have no credit. And if you're a credit-worthy customer and go postpaid, you actually finance the phone, so you actually pay for it. So it's actually a little bit backwards from if I go put my financial analyst hat on, I kind of scratch my head a little bit at some of the things that are done in the prepaid business. It reminds me of some of the crazy things that we used to see in the video business. Some of the things we saw in the OTT business where you sell below cost and make it up on volume, and University of Tennessee freshman class finance 101. That's the one thing I learned. I only learned one thing in finance class, but I did learn that, and so we're going to try not to do that.
So John, this is Tom. So to Charlie's point, that the silliness of some of the activity that goes on in prepaid is the discipline that Eric referenced that we're going to be injecting into Boost. But your question was really around wireless strategy in general, and we don't view our opportunity as only prepaid and postpaid. There's a huge wholesale opportunity. As we open up a market and unleash 100 megahertz of mid and low band spectrum, we're going to have so much more capacity than we need for pre and postpaid. And at the same time, with the Huawei push coming out of DC, there's quite a bit of support now for O-RAN, and the desire for a U.S.-based telco ecosystem. So we're seeing basically we're getting inbound activity from every major technology company in the United States, whether that be enterprise-focused companies or cloud-based companies, and they're all successfully now running telco instances in the cloud. So the progress that we've seen over the last, call it 5 to 6 months around automation, network slicing, and the ability to sell wholesale capacity it has been tremendous. So in our minds now, it's inevitable that, and it's undeniable, that O-RAN will be part of the landscape, and the wholesale wireless opportunity is much, much larger than people expect.
Yeah, I think, just as I think if we pivoted to rural 5 years, obviously our subscriber counts went down. We got chastised for not growing our sub base, but we grew our sub base where it counted. And the same thing's going to, but we went where, there was, a solid base. What's going to happen here? We're not just about handsets, as most of the incumbents are. That's going to be a very competitive market. But the fact that an enterprise could have a slice of our network and be able to have their own data and their own security and look like their own network, that is going to be, for a while, that's going to be one of a kind. And there are going to be companies that are going to get a huge return on investment to be part of our network, because we're going to make with the data and the ability to connect, we're going to help them improve their business or their product in a way that they just can't do today. And that will become more evident, I think, to people over the coming years.
So, operator, we probably have time for one more call from the analyst community.
We will now take our final question from the analyst community from Brian Kraft with Deutsche Bank.
Hi, good morning. I wanted to ask you one question on funding and then another on satellites. Just on funding, as you do think about sources of funding for the wireless plan, what are the most important considerations there as you look at the different options for funding the plan? And then as we think about the capital needs for the legacy business, on the satellite side, as some of those satellites reach end of life, are you planning to replace them with your own new ones that you'll build, or is there an opportunity to go back to leasing capacity from another company such as EchoStar? And would you need as many satellites going forward as you have historically? Thank you.
Well, on satellites, we don't have a need for additional satellites in the short term. Obviously, I'm surprised we haven't gotten the question, but obviously, I've said in the past I thought it would be inevitable that Dish and DirecTV probably at some point would be allowed to merge, and that would reduce need for satellites as well. So I don't think that's a material cost on CapEx for Dish in the foreseeable future. With any kind of financing, we're generating a lot of cash flow. So and obviously to the extent that Dave and his team are successful in their build out and their timelines, we're going to generate cash flow from Boost as well. So that has reduced that has reduced some of our external funding needs perhaps. And then we raised $2 billion. We raised $1 billion in the rights offering, I think before the end of last year. And we've raised $1 billion in debt this year. So typically we look at financing. We look for flexibility. We look for interest rate. We look for term. I don't know. We look at the traditional things you'd look at it from a financing point of view. So a lot of what we're doing, is infrastructure. So that's a whole different set of financing opportunities for us because we're building real assets you can touch and feel and spectrum. They're not making any more spectrum anymore, so they are printing money, but they're not making spectrum. So
Brian, this is Tom. I think what we're saying is we'll be opportunistic if needed, but right now, given our cash position and the build-out timing, we don't see any imminent need. The second thing that we're seeing that we're encouraged by is the promise of O-RAN in actually lowering the capital cost of deployment. We're seeing, because you're able to break apart the proprietary traditional system, we're getting radio pricing that is a fraction of what a typical radio historically has cost. That's one area. Second area is as the silicon roadmap matures over the next 18 months, the cost will drop even further on capital. And then on the OpEx side, as you're seeing orchestration becoming more mature in, for instance, with VMware, that's part of the solution that we negotiated with them, but the orchestration layer has an opportunity to significantly lower traditional OpEx associated with wireless.
So if I could follow up, and it sounds like, Tom, I know you're not backing off of the $10 billion number now, but it sounds like you do see some opportunities for that overall build cost to come in below that $10 billion based on what you just said. Is that fair?
Yeah, we're not changing any guidance, and as you know, we traditionally don't give guidance, but that $10 billion has been out there for several years. What we're saying is we have visibility to promising cost curve improvements.
Yeah, this Charlie, I would say that people who discounted that number and said that was an impossible number to build a network, I think you'll start seeing real data that says that's a that's over under, could be a little more or a little less, but that's a pretty realistic. That number is becoming more and more realistic, I think, as people.
Well, in addition, that number predated our deal with T-Mo, so it assumed that you had to build the whole network before you saw $1 of revenue. Given the current structure and the deployment that we're on, we'll be generating cash in the interim while we continue to build the network.
Yeah, so there are two things. One is that the cost of the network, we still believe we're spending $10 billion. The question is, do we have to finance $10 billion? We might be more optimistic about that today, that we wouldn't have to finance as much.
Okay. If I could ask one last follow-up, I promise is the last. Is there a tower count that you would share that corresponds with getting to the 70% coverage in 3 years?
We're not sharing that. We're not sharing the exact tower count, but we're not really trying to hide the ball there. You can. I guess we run the math. We'd say, how many people can we cover with the tower, and you kind of run that math, and you get to 70% population, and our total network build is in the 50,000 tower macro tower range, and to cover 70%, it's a fraction of that.
Yeah, as you know, our FCC commitment is 15,000 towers, and it's probably, slightly more than that.
Yeah, we know we're building a minimum of 15,000, but we believe it takes a little bit more than that to cover 70%. Is that fair? Yep. And we'll get you more guidance on that as we get, as Dave and team have the, as we get site counts. And we have strategically, we have to decide just how dense we make the network as well. So that's a piece of it.
All right. Thank you very much.
Operator, we'll head to the media now.
We will now take questions from members of the media. Again, if you are a member of the media and would like to ask a question, please press *1 now to enter the queue to ask a question. Our first media question comes from Scott Morantz with Bloomberg.
Hi, thanks. Wireless question, obviously. There's a lot of discussion about wanting to get rid of unprofitable Boost customers. You also have some aggressive offers in the market. Just wondering, if you start with 9 million customers with the acquisition of Boost, where do you end the year? Are you going to be up or down from there?
We don't know. I think we said earlier, there's some cleanup on the approximately 9 million Boost customers, certainly cleanup there for customers that we might count a different way or might be an unprofitable customer when you pay for the network. The second thing is as we add customers, we want to add customers that only add customers that are potentially profitable. We don't want to add customers that we would lose for just to have a number for Wall Street. So we're going to be disciplined about the way we do it. Having said all that, from a subscriber count point of view, we look at the financial point of view where we would like to be at least $1 positive, $1 EBITDA positive, $1 cash flow positive. And then as we get owner economics from our own network, that obviously shifts to much more profitable, and we'd be obviously more aggressive in trying to attain new customers. So sorry, that's kind of a non-answer in terms of a number. But it is an answer for profitability.
I hear you. Good luck sticking with that metric.
I didn't hear that.
I couldn't hear you.
Good luck with that measure.
Oh, okay. Next question.
We'll go next to Drew Fitzgerald with Wall Street Journal.
Yeah, two questions if I can. First, you mentioned that you still think, or past tense, that you had thought that Dish and DirecTV, the DBS businesses, would eventually be allowed to merge. Kind of that's inevitability. Do you still hold that view? And then second, there are a couple companies that are going into the low Earth orbit business with very low latency satellites that might address some of the business customers that you're targeting with your 5G network. Just wondering if those plans are successful, how does that affect the economics of what you're trying to do with the 5G network?
Yeah, I mean, I still think Dish and DirecTV will be inevitable. I would, you know, could that be a month from now or 10 years from now? That I don't know. As far as low latency satellites, we're certainly aware of the plans. I mean, obviously I'm on the board of EchoStar. They've potentially invested some more in OneWeb. We certainly understand what Starlink and perhaps what Telesat and others might be doing. We see that any new technology where you can connect things and provide the information, we see that as in general positive. And we think that a lot of the assets that we have in place, including geosynchronous satellites, but also terrestrial markets, they play together. Because I think consumers and businesses are going to continue to consume more and more data, and there's going to be more and more demand for data, and there's going to be demand for lower latency. The satellites will never approach the latency that we're going to be able to get with a modern network. So there's always going to be a latency advantage. You're not going to do gaming and things like that, in my opinion, through satellite. You're not going to do, so a lot of things, you're not going to do industrial production and things like that through higher latency satellites, but they all work together because not every need justifies the expense of low latency. And so for us, we'll try to provide the solutions to our customers that are best for them. If you're a customer that uses 1 gig a month, we'll have a plan for you. If you're a customer who uses 100 gigs a month, we'll have a plan for you. If you need low latency, we'll have a plan for you. If that's not a factor, we'll have a plan for you. And we're a unique company. We actually technically understand most of those things. And again, we're pretty good at satellite. We're pretty good at video. We're getting really good at 5G Open RAN architecture wireless.
So, operator, I think that was the last question in queue. So thank you, everyone, for joining, and we'll talk to you again next quarter.
You have been removed from the call.
This does conclude today's conference. We thank you for your participation.